Okay. Okay. Tomboya, you're saying you need to learn how to manage bigger loans. Okay, just to let you know that you're at the right space. So I see we are 5 minutes past the hour. Just say Kamau CEO Lompsago Sacco. You are on board and looking forward to learn matters on business loan. Okay, so I want to bring this session to a start. So good morning, everyone. Thank you very much for joining us. My name is Jimmy Chakacha. I work for the International Finance Corporation as an SME banking consultant. I support this project and I support other projects on banking on women and SME projects. And today I'm honored again to be your moderator for this session. I'll be supporting Esther together with Peter from the CoopBank side to ensure that we all have a smooth flow of this session. We are going to have polls. We are going to use the chat box as our space for communication, just to ensure that none of us is left behind. And today we'll be looking at loan management. This is a financial literacy program between the CoopBank of Kenya and IFC. For those who don't know, IFC is a short form for the International Finance Corporation. It is part of the private arm of the World Bank Group that we partner with financial institutions to ensure, like for example, in this undertaking, that SME run profitable businesses. So without much ado, I'd like to hand it over to Peter to make introductory remarks from the CoopBank side, and then Peter will hand it over to Esther. Then we will quickly proceed. Otherwise, thank you very much. Have your pen and paper ready. We are going to really have a good session. Over to you, Peter.
Thank you so much, Jimmy, for that introduction. And just before we start the session, maybe we can bow for a word of prayer. Let us pray. Our dear Heavenly Father, this morning we want to thank you. We want to appreciate your goodness and your mercies. As we start this session, we want to pray that, Lord, you be together with us. You be together with our customers in their businesses, and all the insights that you're going to pray to share today. Lord, we pray that you help us be able to implement in our business. In Jesus' name, we do pray and give thanks. Amen. Thank you so much, Jimmy, and our customers who already joined this session. It's really a great pleasure to have you again. We started the very first webinar last week, where we are talking about economic outlook for 2022 for those who were able to join us. And I can see a good number who've not been able to join even last year, but I think this is part of what we've been doing with IFC collaboratively to just ensure that we keep training our customers, ensuring that we give some tips that are very key in managing their businesses. And as Jimmy have indicated, last year, we had done 7 sessions together with IFC, but we had done actually more. I think last year alone, we did more than 50 webinar sessions with other programs, and I can see that quite a number of us were able to follow through. And just to remind ourselves that we continue to support us on impacting our businesses, both on financial solutions and non-financial solutions. And when you're saying non-financial solutions or non-financial services, these are the trainings and these are the capacity building programs that we have in the bank to continue impacting and ensuring that as we do business, we also use good management tips to continue training, to continue implementing in our businesses. And so I think for us is to really welcome all of us, from IFC, Gideon, Jimmy, and Esther, who will also be our trainer. Thank you so much. The staff members of CoopBank who also joined, and of course our participants. Looking at the numbers, I can see we are almost 80 of us already. And I'm very sure we'll have great numbers. So karibuni sana. Let's continue with this particular program together. Let's learn as we do business, because this will also be a very busy year where we want all of us to learn. So without further ado, I want to take this opportunity to welcome our trainer for the day, Esther Macharia, who is our lead trainer in this capacity building program, to take over with this presentation and this training. I'm very sure later we'll be coming with some solutions from the bank. Anthony Kinyu-Angeshi will be our speaker. On our MSME solutions, he will share some of the products that we also have for you to grow your business this year. Asanteni sana and welcome, and over to you, Esther. Thank you.
Thank you, Peter. Thank you for that introduction. I thank you, Jimmy, also for starting us off. For those whom we have not met before, as you have heard, my name is Esther Macharia. I am so glad to be here with you, talking to you, very important business people, and we can see how can we be able to grow our businesses and even especially manage loans. And I'm talking this from a background where I have worked in the banking institution for over 20 years, just dealing with the small business people, or I can say the business people, and looking at the way they come, they borrow the loans, how they use their loans, and there is truly a great need for us to have this particular topic. So today we are going to be looking at loan management. And this is after covering about 7 topics, like Jimmy told you, to do with financial management. And the reason why we are seriously looking at this course is because we know you have several challenges that you face when you're managing your loan. And the course is going to equip you with all the skills that you are able to manage your loan very well. And for us to be able to cover all this, we just go ahead and go to the first agenda so that I'll be able to show you exactly what we are covering today. So we have started with our introduction that we have already done. And then we have agreed on the ground rules that Jimmy gave us. So we respect each other, we participate, and then the microphones are muted. So our mode of communication is through the chat. And if you have a question as we go along, put it in the Q&A tab. We'll go answering as we go along. And also if we have a chance at the end, we'll have that communication. So we are now going to look at the topics that we are going to go through. We'll have borrowing consideration. We'll look at selected loan types, the differences between good and bad loans, and also we look now eventually at the loan management. And with that, we just go in and start the course. So walk with me in this journey. Do not be left behind. Be alert, participate, participate. That is the way we get to learn. So in this particular course on looking at the loan consideration, we are going to determine the need for a loan. That is where we start off. We need to determine, do you really need the loan? And then we'll explore the different funding options and also decide on the type of loan to take and the consideration taken when you're taking a loan. So that is what we are going to explain in borrowing consideration. Then we'll go to the second session and we'll look at the correct loan type. Which is the correct loan type for you? According to the need that you have, then what is the correct loan type? And eventually, even what does CoBank have to offer you in terms of your need? Then we'll differentiate between good loans and bad loans. You'll be able to differentiate between good loans and bad loans, and also eventually we'll go to the area where you need to learn how to manage your loan better. So these are the key objectives of this course. We explain borrowing consideration, selection of the correct loan type, differentiating between good and bad loans, and eventually managing your loans better. So I request you walk with me so that we are able to go through this course together. And now to start off, we start off with an activity. We want to identify the benefits of loan management. Let's go to our chart. What are the benefits of good loan management? Please share with us. We have 2 minutes. Share with us. What are the benefits of good loan management? And Jimmy, as the answers will come through, Jimmy will take us through the answers. So just let's participate, let's chat together.
Absolutely. Okay, so one says one of the benefits of good loan management is better credit ratings. Just to say it cautions the business against loss. Okay, thank you very much for that. Let's see whether we have other contributions. Better loan management enhances business growth. Another one says it reduces risk and bad debts. Okay, that's Karani. Thank you very much. Let me take 2 more and then we shall proceed. It improves business cash flow. It helps us to plan our finances in a sustainable way. All right, and the responses are coming. It reduces cash flow stress, easier loan approvals. Let me take one from Stella. Stella say it helps in managing loss and bad debts, reducing stress. Okay, helps to grow your profits. So over to you, Esther, and thank you very much, guys, for your feedback. It's still coming, so keep them coming. We will keep sampling them as we go along. So over to you, Esther.
Oh, wow, thank you. And thank you for that participation. I can see the great benefits that are there with good loan management. Once you manage your loan well, what happens? We can see the benefits that are there. So this topic is very important for us. And now we are going to summarize probably in just 4 points that will actually cover most of what we have. One of the things is that when you manage your loan better, the benefit that you're going to get from this course, you're going to access more credit for business growth. So the content of this will also be designed in such a way that you're able to even get more credit from Co-op Bank, and especially because we have got all the loans that you need. Then also you'll be in a position where when you manage the loan better, you match your loan to your business needs. You don't just take a loan for the sake of it. You take it for according to the needs. Then eventually the course will help you. It will benefit you in differentiating between good and bad loans so that you can opt to take good loans and then you can live out taking bad loans because you see what bad loans can do to you. You will also be in a position now to help you manage your loans so that you're able to overcome all the challenges that either you're experiencing now, or if you are very lucky, you will never experience them after this course. So we are going to look at the topics that we are going to cover. And with that, we'll go to our first topic for the day. This is borrowing considerations. And with this, as we go along, there'll be lots of exercises. In this session on borrowing considerations, we are going to cover the following topics in very short form. So, determining the need for a loan. We are going to get to the area where we determine the need for a loan. We'll look at funding sources. Where do you get your money from? Then borrower's consideration. As a borrower, at the point you are going to borrow, what should you consider? Then we are going to let you in on a secret. What the lenders look for when they are giving you that loan. What does Cooperative Bank look for? And at the end of the session, you'll be able to determine the need for a loan. You also be able to consider your funding options because we would have given them to you. You'll be able to list at least 3 borrowers' consideration, what you as a borrower you should consider when you are borrowing. Then you'll be able to list at least 3 lenders' consideration. What is my bank looking for? And with that, we just go straight to our first activity as we look at this particular course, and we are going to go to a case study. I have it there on screen, but I'm going to read to you. I want you to be very keen on this. We want to help Catherine. Catherine is a businesswoman based in Kisumu. She has been running her M-Pesa business successfully for the last 5 years. To increase her float, she applies for a 150,000 loan, 150,000 overdraft, which is granted because of her excellent credit rating. Catherine instead decides to use the overdraft to finance a family holiday in Mombasa. Probably it is Valentine's like it is now. The loan ends up straining her business and she approaches you for advice. There are 2 questions here. What is Catherine doing wrong? And then, why should business owners take loans? So answer the first part and also answer the second part. What is Catherine doing wrong? And why should business owners take loans? So we have 2 minutes. Let's share on chat. Put yourself in Catherine's place. Help, let's help. Because we know we have probably a Catherine in our midst. Let's go to the chat. And over to you, Jimmy.
Esther, thank you very much. And as we think and as I reflect on Catherine's case study, let me just quickly read some of the benefits of loan management that had come that I wasn't able to read. Japheth had indicated that it will enable easier loan repayments, and then Geoffrey had indicated it improves business growth. Further, it allows you to use the loan for the intended purposes. Okay, I see Stella is saying, commenting on Catherine case study here. Okay. Job is saying she made a mistake by diverting to an unpaying venture. Japheth is saying using a loan for a wrong purpose. Okay. Mbatia says Catherine is using the overdraft on leisure instead of investing in businesses. Okay, let me take one last one here and then we can proceed. Dennis says she took a loan and enjoyed her on her holiday. He used borrowed money for luxuries. Okay, so the majority are saying Catherine is doing the wrong thing. Okay, Dr. Irungu, thank you very much. Okay, she's wrong. She's using loan money for family holiday, yet she has not used the money for investing. Thank you very much. The feedback is still coming. So over to you, Esther.
Wow, those are great feedback. And as we go along and we look at these case studies, I believe that at one point or another, you can see the kind of answers there that are coming through. You take the loan for business, then you divert it to personal needs. How many times have we done that? Then you end up straining your business to pay a business loan that actually it became a personal loan. You take the personal loans and then it goes for the business to pay. And you can see what it does to you. And you are drawing down the capital of the business. Then we are asking, why should business owners take loans? Why should they take loans? As you go along, why should you take a loan? And I believe this is the key question that we need to be asking ourselves. And we are going to look at this so that we are very clear. By the time you go to take a loan, you have identified your need. You'll take a loan only to stock the business, or if you're in the service, you're financing a contract. This is what we call working capital. The business will generate money from the sale of the stock, that you have in the business, or from the service that you're going to provide. The other thing is to meet the business running cost, not the personal running cost, your business running cost. You are probably just a little bit strained in terms of paying the rent, the salaries, and such kind of things that are going to be productive. At that particular point, you can use a loan. So the money that you're going to receive from your customers eventually are going to pay back your loan. Then also, if you're growing your business, this is what we talk about business expansion. At that point, you can take a loan. Because the moment you do that, this is a worthwhile investment. And the loan will expand your business. It will bring in future cash flows that you're going to use to pay the loan. The other time you can take a loan is when you're buying a business asset. For example, you're buying a motor vehicle that is going to be used in the business, not for you to feel good in, but to be used in the business. You're buying a building, the machinery, or any other fixed asset within the business. Then at that point, through the use of that asset, you're going to generate cash that can be able to repay the loan. So in all this, what we are saying, you only take the loan if it is going to generate money that is paid by your customers, so that the loan actually is paid not through your sweat and blood, but through serving your customers. So now from what you know is that now you know why you need to take a loan. And as we go along, ask yourself, the last loan that I took, did I really need to take it? And if I did not need to take it, what will I do in future? Because mainly these are the 4 main times that you need to take a loan. And now we are going to look at what do you consider when you are looking for funding. When you're looking at funding options, what do you consider? And with this, we are going to have a poll. Jimmy is going to share with us a poll. And in the poll, the question we are answering is, how do you finance your business? So that you can see the funding options. How do you finance your business? Jimmy, please share with us the poll. We'll have 2 minutes. And after that, we can be able to see what our customers are saying. How do you finance your business? Please participate in the poll.
All right, so thank you very much, Esther. So the poll is up. I see we are doing well on time. Okay, and we are asking, how do you finance your business? Tick the one that applies to you. So these are multiple choices. So you can tick more than one. And then I'll close it up in the next couple of seconds. And then we will proceed. Otherwise, thank you for those who sent in the other comments that I wasn't able to read. And as far as Catherine case study was concerned, let me just take 2 as we wait for the poll to come to an end. Okay, we take loan for the purposes of increasing stock in our businesses, which wasn't the case in Catherine case study. Okay, so let me just take one last one. Okay, to expand business or to start a business to boost the established one. Okay, business owners should take loans to boost their businesses. Okay, so Esther, let me bring to an end our poll and let's see how we have fared on. 77% had indicated savings, 28%, that is 17 out of 60 of those who poll says friends and family is how they finance their business. Suppliers stood at 35%, banks 57%. Those who said financials as their source of finance for business were 32%. And then lastly, 7% of us had indicated Shylocks. So over to you, Esther.
Well, it's just good to see that the kind of ways that we finance our business. So what we can say that it is very important for you to really explore your funding options before taking a loan to ensure that you get the most cost-effective loan solution. And from all that we have gone through, we are going to go through each one of them and see what we need to consider. So we are going to look at some of the advantages and disadvantages of each funding option. So here we are, we have personal savings. One thing with personal savings, there is no cost to you because you are not paying anything. So there are no terms, it is usually easy and cheap. The disadvantage is that you risk losing all your savings. Then when we go to family and friends, they are going to either give you at a very good rate or they'll give you for free. Some families, friends will charge you a rate, others will give you for free. They are very flexible. Anytime you are able to get it when they're in a position to lend you. They are flexible and they give you the best value. The one thing with family and friends, it can create a lot of friction in the family. This is one thing that can bring a family down, can bring a friendship down. There is a probability you keep on being reminded, if it was not for me, your business will not be where it is. So that is the risk that you take when you go for family and friends. Then you have the suppliers. They'll supply you with goods and you can pay probably in 30 days. They'll not charge you anything. So it is very inexpensive and it is unsecured. The big disadvantage, it's usually short term and it is only restricted to only the supplied items. So if you're looking for operational expenses, you may not get it from the suppliers. Then we have the banks. They have a cost, mostly that may range from 6 to around 14%. Their terms are quite flexible, all the way from 6 months and may extend to 5 years or 6 years, depending. Then they are highly available. They are all over for us. In Kenya, we have over 43 banks. So definitely there they are. And I know Cooperative Bank is in there serving the SME. Then they are generally very hard to qualify for. They are so keen on looking at various things. So that is the big disadvantage with the bank. You really need to make your credit rating good. Then we have the financials. This in the financials, you find that their rate, their cost is high. It's 25% or more annually. At their terms, mostly they'll give you within a few months. Then they are easy to get and they are very immediate and they have very minimum requirement. You walk in, you walk out, you make a call, you get your money. They're very expensive and they can cause the borrower to fall into a very bad debt cycle. You can become, what can I say, that addict to debt because you'll be borrowing Tom to pay Peter. And you form what I call a merry-go-round of borrowing. So you should be very, very careful not to get into that cycle. It's even worse when you go to the area of the Shylocks. Now, that we can see all the financing options that we have. We'll also be able to see even from a bank perspective what there is to offer. We are now going to look for you as the borrower. What should you consider before you take a loan? Before you take that particular loan, before you take that step, what should you consider? And in this, we are going to go back to Catherine. And let's see what we have. I want you to listen carefully. Catherine's monthly business income is 150,000 Kenya shillings. Catherine applies for a 5-year loan of 1.5 million with Co Bank for business expansion. She, however, uses the money to fund construction of her family's residential house in the village. She later draws 200,000 shillings from her bank overdraft facility to fund the expansion of the business. 1 month later, Catherine's business needs working capital financing, but she cannot borrow from the bank because the overdraft limit is fully utilized. She opts for a Shylock loan of 100,000 at 40% interest for 2 months and surrenders her logbook as security. The questions that we need to answer: what is the problem with Catherine's borrowing? And then let us advise Catherine on what she needs to consider when borrowing. So the first thing, define the problem with Catherine's borrowing, and then what does she need to consider when she is borrowing? Let's go to chat. Let's get the answers to this. Let's go to our chat. What is the problem with Catherine's borrowing? And then let us advise her on what she needs to consider when borrowing.
Okay, Esther, so let's
Yeah,
see.
Jimmy, when we get, yeah.
Okay,
Go
Mohammed
ahead,
says
Jimmy.
she should, thank you. She should consider the interest rates. Thank you very much, Mohammed. Ability to repay needs to be the first thing for consideration. Okay, that's Jesse. She should use the loan, the business expansion, not for home building. Okay. All right. Janet, you're saying not using the borrowed money for the intended purpose is what is wrong with Catherine in this case. Okay. Phyllis, you're saying she misappropriated the loan into bad loan that cannot repay itself. Okay. Consolata, you're saying she needs to set a boundary of personal use and business use. Okay, so the responses is coming very quick here. Let me take last two and then we proceed. Okay, so thank you very much, Stephen. You're saying Catherine used the loan to fund the wrong purpose. And then let me take one last one here. Thank you, Tony. I see you're dropping your comments there. Benson, you're saying borrowing to build a house that will not generate income. So thank you very much again, and over to you, Esther.
Thank you. Thank you, Jimmy, for those responses. And thank you for giving us all that. You know, now we are learning from each other. And we can see most of the things we do on a very daily basis. We divert the funds. We think that a house in Ushago, in the rural areas, is very important. And we invest in what I heard somewhere called a dead asset that is not giving us any income. Then she ends up getting into too much debt. You see the cycle. You make one mistake and it has a domino effect of having several mistakes. You get your business income and you're not able to support the loan repayment, and this creates a lot of stress for you. So now let us look at the borrower's consideration. This is what Catherine should consider or should have considered, and for us, what we should consider. Now, when you're borrowing, when you're looking at the loan product, we are going to look at two areas. What you consider relating with the loan product and what you consider relating to the business. In terms of the loan product, you should look at the type of loan product. And the question you should ask yourself, is this loan product short-term or long-term? Is it short-term or long-term? Then ask yourself, does it require monthly repayment? Or is it that will go for bullet repayment? So that is also one thing to consider. Then what is the cost of borrowing? And when you're looking at the cost of borrowing, do not look only at the interest rate. There is usually the interest rate, there is the loan processing fee that come with it, there are legal fees that are usually inside that particular loan, and there is also the insurance fee. Every time when you're borrowing a loan, there is something that is usually called the total cost of credit, or the TCC, total cost of credit. You should look at it in totality. Ask, what is the loan processing fee, any legal fees, interest rate, the insurance? Those you should always check. Because first of all, these are charged on the principal amount that you borrow and not on a reducing balance like the interest. Then the loan repayment period. How long will I take to pay this particular loan? Will I finish it within the time that is set and according to the need that I have? The other thing to consider in the loan product, what security or collateral is needed for me to get this particular loan? You may find that, yes, there are those loans where no security or collateral is required. They come very fast, but also the cost is very high. So always look at the total features of the loan and see whether they fit according to what you are able to take. Then on the other end, when you're looking at the business, the key questions and the areas to look at is ability to pay. Is my business able to pay this loan, or will I have to draw from other areas to repay the loan? The loan that you take for the business should actually be paid by the business. So take a loan that is within the ability of the business to pay. Not a loan where you're either going to sell your assets or you'll be offering services elsewhere for you to come and repay the loan. Then the amount to borrow. How much do I borrow? Do not borrow more than your business requires. That is going to kill you. It is what a banker would call overfunding. No matter how much you're being told that your business qualifies for, or according to your bank statement, we see you can qualify for this amount of loan. The thing that you should ask yourself is, does my business need that loan? The moment you have excess, you're going to misuse it. Then existing debt. How much debt do I have outside there as I go to borrow this one? Always take that into consideration. What I say is, out of your total income, you should not use more than 70% of that income to pay debts. Then, purpose for borrowing. Why are you borrowing? It is very important for you as a business person to ask yourself the question, why? And get an answer. Why am I borrowing? Then you ask yourself, must I borrow? Then, business cash flows. How are my business cash flow? When do I have those high cash flows? When do I have the low cash flows? And at that particular point with monthly repayment, will I be able to service my loan? So as a borrower, this is what you seriously look into. Once you look at all these items, before you borrow, do not go to borrow as an emergency. You must have had a meeting with yourself and your business before you go for that debt. And debt is good, and you're going to see. Now, let us look at the lender's consideration. You have finished considering for yourself. Now, what is your lender looking for? The lender usually uses 5 C's of lending. 5 C's of lending. And the very first one they look at is your character. The character would describe your creditworthiness. They're looking at high ethical values and honesty in your management. That is why they'll visit you, they'll talk to you. They're assessing that. They're looking at business integrity. And they also look at the credit history. And can I tell you, even your bank statement is able to determine your character. Okay? They'll be looking at how you deposited withdrawn. Then there is the capacity to repay. Are you really able to pay back this particular loan? And this is where all the ratio, the financial analysis come in. They're going to look at how is your liquidity? Do you have enough money to pay? What is your debt ratio? Are you too indebted to be given more money? Then on top of that, they are going to be looking at the fact that, does your business really need that particular money? And they will advise you accordingly. The other thing that they do look at is the collateral. What are you giving us just in case things go bad? And when looking at the collateral, how accessible is this collateral? And then what is the value of the collateral? Looking at the agreement. Can it be easily sold? That is why you can be having big machines, but probably they're obsolete. Your financial is not going to take that. Your bank is not going to take that. And then they are going to subject that particular collateral to regular valuations to just know exactly how it is being taken, whether they can actually get money out of it. The other area that a bank really looks at is the conditions in the market. When you're looking at the conditions in the market, you're looking at the fact that, how is the economy at this time? How is the economy at this time? It's the electioneering period. This is the kind of business. Will they still be able to pay? Then you're also looking at the national, the international, and even the local market, just where you are. How is the progress in terms of the business? Then regulatory activities. How is that business regulated? Like now you can look at the areas of the scrap metal. Right now, if you're in the scrap metal business, you step into a bank to borrow a loan, there'll be some jitters here and there because of the regulatory activities, the regulatory framework that is there. So all the legal developments that go on, those are conditions that the bank is usually on top of. The other area is the capital. The capital, what is your share of the pain? How much have you put into that business? Have you invested in the business? You're looking at the startup cost. Which assets do you have? That means you have put some money into it. So is there some working capital within the business? This is what a banker will call sharing the pain. They don't want to get in and finance your business 100%. Okay. And now these are the key 5 C's that a bank will look at. And as we look at that, now I want you, since we have seen the 5 C's, and you know them, and you have looked even at your credit, I want us to go and see if you are a leader or where you are at. I want you, we go to the chart and we list 2 actions that you can take to improve your credit rating. It may either be in character, in the capacity, collateral, conditions, or capital. What are the 2 actions that you can take to improve your credit rating? What would you do? Let's share on chat. What are the 2 actions you can take to improve your credit rating? And Jimmy, as the answers come through, please share with us.
Absolutely. So let's wait. Okay, they're starting to come in. So 2 actions that we can take to improve our credit rating. Okay, let me take the first 2 here. Improve character to sustain the capital. Pay your loans on time. Okay, pay your loans early, pay your loans on time. Okay, so the majority of us are saying, if we pay our loans on time, then our credit ratings are going to improve. Let's hear from what Charlton is saying. Grow my physical assets, keep proper financial records, pay loan obligations in time, that's Benson. Consistency in payments, that's Mary. Let me take one last one from Stella, and then I'll take it right back to you, Esther. I will pay on time, okay, record keeping of sales, transact through the bank, proper financial records. So over to you, Esther.
Thank you. Thank you, Jimmy, for that. And thank you for those responses. And I'll highlight a few things in each of these C's. When it comes to character, as you do your loan repayment on time, which is very good, improve the quality of management. Improve the quality of your management, the way you manage your business. You're looking at experience, you're looking at integrity. And that is why attending trainings like this will help you to improve the quality. Then when you're looking at the conditions of the loan and even of the economy, always remember to read the terms and conditions of the loan. Look at that. And also look at the industry. Look at the time you're going to borrow this money. Is it the right time? Keep up to date with the government regulations. Be keen on the government regulations that are coming on board. So always look at that. Then when you're looking at the issues of the capacity, do not overborrow. Do not overborrow. Always compare the monthly commitments to your business income. Then when you're looking at the collateral, as you go along, build your business assets so that you're able to get collateral. Also, you can build your savings because it can be used as collateral. And then when it comes to the area of capital, practice the issue of plowing back your profits into the business. Do not take all your profits 100%. Plow back your profits. So if you go looking at all this, then you'll be in a position where your business is growing at a good rate. So with this, we conclude our session on the borrowing consideration. So we are going to move on to the next agenda, which is the selection of the loan type. How do you select the loan? I know most of the time you ask yourself, which loan product do I select? And also as a business person, you probably step into the bank and all that you know is, I want a loan. But in terms of which product, you are not even aware. And I can tell you, you are not alone in this particular area, because most business owners, they struggle in choosing the right loan. And this session is going to equip you with some guidance on selecting the most appropriate loan type. So we are going to cover the following topics. We are going to look at the general financial loan products for the small and medium enterprises. We also look at matching loan products to business needs. And at the end of the session, when we are finishing off this particular training, we're also going to have CoBank who come on board, and they'll give us the products that they have for the small and medium enterprises. So at the end of the lesson, you should be able to list 3 short-term loan products, and also list 3 long-term loan products, and also match your business loan type to the business needs. So that now you'll be walking into the bank saying, I want loan A, I want an overdraft, I want a long-term loan. So those are some of the things that we are going to be looking at. So let's look at the most common financial products. But before we go into that, which loan products do you use for your business? For those who have borrowed loans before, which loan products do you use for your business? Please share with us on chat. Which loan products do you use for your business? Jimmy, if we get when we get some replies, let's just go through them.
Absolutely. Yeah, so the first one here, Steven says personal loan is one of the loan products that he uses for his business. Okay, they're coming in. Let me just, okay, give me a second. Joshua says both long-term and overdrafts. Chad says business loan. Son, you're saying MCOP cash and MSME loan. Okay, business loan, personal and friends, asset loan, MSME loan. That's James. Thank you very much for that. And the responses are coming in. Thank you very much. Salary advance, 12 months term loan, circle loan. Okay. So let me pass it over to you, Esther. Thank you very much, everyone, for sending in your comments there.
Wow, that is great. And thank you, Jimmy. We can see the loans that we are using. Now, we are going to look at the general loan products for SME, so that when you go to your financial, you're able to look for them. Mostly, there is the short-term loan that you're going to get in the bank. In the short-term loan, this is mostly used for restocking, for business operations, or for expansion. When you're talking about a short-term loan, this is a loan that is payable within 12 months. It cannot be paid in more than 12 months. So that is a short-term loan. Any loan that is paid with more than that, then that is a long-term loan. Then we also have the overdraft. You use overdraft for emergency business expenses, where you find yourself that here I am, I'll be needing probably cash quite often, and there are those business expenses that can come in. Then you're applying for a line of overdraft. So only use it for emergency business expenses. Then you're traveling. When you're traveling, you need credit cards. So that you don't carry cash, you can go and use credit cards as you do your travels. Then there is vehicle and asset loans. That is vehicle and asset financing. For this, you only use for asset acquisition. When you want to buy that vehicle, when you want to just acquire that particular machine, then you go for vehicle and asset financing. So you say in this case, you have identified I need a vehicle. So I go for asset financing or vehicle financing. I acquire my asset. Then there is mortgage loan. When you want to buy a business building or a building for business, then you go for the mortgage loan. It is also for asset acquisition. And these particular assets, mostly, they're the ones which are still used as security. Then you have what we call equity release. In equity release, you have probably a building which is there on mortgage, and there is room for you to borrow more that can go towards business expansion. Then you can go and the loan is loaded onto that particular mortgage that you have, and you get loan for business expansion. So the same particular item, building that is charged in the bank, so there is a room for you to borrow, then you're able to get that. And that is what we call the equity release. It's used for business expansion. So do not go for mostly for just working capital, for the normal working capital. And then there is leasing. You want to acquire a certain asset, but you don't want to buy it. Then you go for leasing. This is used for running the business. You need some vehicles, or let's say you are in heavy duty, you're in road construction and all that. You cannot go buying all those earth movers. So what you do, you lease the earth mover, you go do your job, or within the course, they'll give you either 2-3 years, and you'll be working without really buying that particular asset. That is what you do with leasing. So these are the major products. There is also the long-term SME loan that is there. It is used also for business expansion and also for restocking your business, depending on the level of your business. Now, beyond this, we have what we call the trade products that are available. Under the trade product, we have products like invoice discounting. And this is part of bridging finance. It can also be used for import. So when you're talking about invoice discounting, it allows you as the customer to access cash while you're waiting settlement of your invoices. And the purpose for this product is actually to just bridge the debtor's gap. Okay. This particular kind of loan, you don't need extra collateral. Then there is what we call contract financing. This is also a facility that is usually provided so that you are able to execute your contract. Then after your contract is over, the money is paid through your bank account and the bank can recover that money. What usually happens in contract financing, you are granted a credit line that mostly does not exceed 1 year, but it is renewable. So you can do this where you go do your contract, the bank has given you a credit line, and then after the contracts are paid, they recover their money from there. Then there is purchase order, or what we know very well as LPO financing. In this case, you have an LPO, you take to the bank is able to finance it. Then when you are being paid, the money is paid directly into your bank account and the bank can recover the money from there. So in this particular case, the prices are agreed on the product. And of course, the person who has issued the LPO must be of very good standing. There are people who actually pay and not organizations or probably government arms that do not pay. Then we have another one that we call factoring. Factoring, it's where you find that you have got quite a number of accounts receivables and you need to go collecting money from these debtors. Instead of you collecting the money from the debtors, you have a discussion with your bank and you agree that in this particular case, take these accounts receivables, you get money from them because you as a bank, you even know how to collect debts more than I do. And then for me, you give me the money. You'll not be given 100%. You'll be given a certain percentage, probably 80 or 90. And then the bank will be left collecting the money from the debtors, which they will pay. And that is the way your loan in factoring is paid. So this helps you a lot in really managing your business on a day-to-day basis. So that is why it is very good for you to really identify what problem am I facing in my business? What need do I need sorted? Is it invoice related? Is it debtors that are too many? Can I have a conversation with my bank and they are able to sort me out so that you get the appropriate credit? So do not always be looking for LAD for you to go get the loan. What you need is a discussion with your bank and of course, from a point of knowledge. Then there are also some other off-balance sheet products. This is where we talk about letters of credit, mostly used in the import and the export. And mostly this is an irrevocable undertaking by the bank. And they are doing it on your behalf, that they are going to make payment of specified amount to a specified beneficiary whom you are buying from. And it has a certain date. So the purpose for this is to finance import of goods into the country. And they guarantee payment for services rendered to a business by another party. So if you are importing or you are bringing in some goods, and also the person you're importing from definitely would deliver, then in this case, go to the bank and ask for a letter of credit for that particular area. Then we have bank guarantees. This cover against default. In case you're given a job to do, one of the things is that the person who has given you the job may decide that before I give you, like now, if you have a supplier of goods to your premises, they tell you, before I give you these goods, I need a bank guarantee of probably 10 million. You go to your bank, you get your bank guarantee. The bank guarantee, what your bank is saying, I guarantee payment of what this customer has taken when they do not pay. So it is a guarantee, and even it has a certain date that if the payment is not paid by this date, probably you have gone to EABL, you have taken some crates of beer if you're in that particular business, then there is the guarantee. In case it is not paid, then your bank can actually pay EABL, they can pay Unilever, they can pay all the others. Now, we also have bid guarantees or bid bonds. And this goes especially to the construction. It's usually a surety that this person is going to complete this construction project. Your house is being built, or somebody has given you work to build their house, their office. They will ask for a bid board, for a bid guarantee. And this especially is asked at that point you're getting the tenders. You can go to your bank and you're able to get this. And it is called a bid board because it is used by the client to pick among various construction companies who are competing for a job, so that in case payment is not made or you don't complete your work on time, then the person who gave you the work can be compensated for time wasted, okay? Because they might be forced even to go and look for somebody else to do that. Then we have, when you're looking at big projects, then you go for performance guarantees or performance boards. So this also is given by the bank where you are doing big construction like road construction, or even you're doing real estate construction. For the bid boards, they are on a smaller level. Performance boards are now at the high level. So I believe depending on the kind of industry that you are in and the kind of need that you are in, you know exactly what to go and ask for when you're going to the bank to ask for a loan. you know the kind of need and exactly what you need to be asking for so that you're able to match all these. And as we talk about matching, let's look at the considerations of matching your need to the loan. What are the matching considerations? So what I'll say is just about 2 points here is match your loan products to your business needs. For short-term business needs, go for short-term loans. And when you're talking about short-term business needs, we are talking about LPO financing, invoice financing, invoice discounting and all that. Those are short-term. Go for the short-term solution. For long-term product, these are for long-term business needs. You are talking about where you're going for business expansion, you're going for asset financing, you're going for a construction loan. This is where you take the mortgage, the asset financing, and where you take even the long-term SME loans. So how long is that need expected to last? Then you take a long-term product. The other thing is match your loan product to the cash flows of your business. For contractors, match your contract schedule of payments according to the loan that you take. This is where you're going for LPO financing, you go for invoice discounting, you go for contract financing and all that. Then we have for the retailers, you're matching your business needs with SME loans that you're taking. Am I taking a short-term loan or am I taking a long-term loan? So always look at matching the loan product to the cash flow of your business and matching your loan product to the business needs. And now with that, let's do an exercise with us. Let us now help these particular businesses and we look how can we match their needs. So based on what we have learned, let's advise these business owners. Be keen, let's go to our chart now. So we have two scenarios. One, Millie runs a tailoring shop in Juja. Her business has been expanding and now she needs to invest in buying 3 sewing machines. Each of the machines cost 15,000. The total cost is 45,000. She is thinking of taking a short-term loan, repayable in 1 month at 7.35%. What product would you advise Millie to take? Let's go to chart. Let's first of all deal with Millie. What product would you advise Millie to take? Let's go to our chart. Jimmy, as they come in.
Okay, so I'll be reading through. So one here, Ansieta said asset financing.
Mm-hmm.
Francis says short-term, the machine are assets, so long-term loan. Mm-hmm. Yeah, and just to let you know that we are almost 10 minutes away before Copa come in for their presentation. So far, so good. So Stephen says asset financing. Okay, long-term here is the response we are getting. So over to you, Esther.
Okay, thank you. And that is great. I can see we are together. Actually, she's buying business assets. Long-term loan will be good. Now let's look at Faith. Faith is a retailer. She gets her stock from Guangzhou, China. She needs to buy stock of 100,000. She's considering an overdraft so that she can pay the importer directly in Guangzhou. What loan product would you advise her to take? What would you advise Faith to take?
All right, so let's see what advice we can give Faith.
Mm-hmm.
Okay, getting a stock from Guangzhou in China. Mary says short-term loan that is payable in 12 months. Thanks, Mary.
Yeah.
Yeah, the rest. Letter of credit is what Margaret Ndungu is proposing for Faith. Okay. Overdraft, thank you, Benson. Bank guarantee. Let me take one last one, then we go forward. Okay, Consolata says bank guarantee. So over to you, Esther.
Thank you. Thank you for those replies. We see for Faith, a working capital loan will be good for 100,000. And then also a letter of credit. She is importing. Where the goods are very specific, then she can get a letter of credit. An overdraft, you may find that it may actually eat into her finances. So let's go for working capital loan. That is a short-term loan of about 12 months and a letter of credit. And now with that, I can see we are on board. We know exactly what to do. Let's move to the next topic that we need to complete. And this, we are looking at the difference between good and bad loans. We need to look at this. What are the good loans? Which are the bad loans? So at the end of the session, we should be able to differentiate this. And we are going to go through it by looking at some examples. We have this lady who is called Mary Chapakazi. She takes a loan of 150,000 at 12% to buy a Frisian high-grade cow payable over a period of 2 months. Then she takes a profit, she makes a profit of 41,750 per month after expenses, okay? And ends up repaying the loan in 6 months. Is this a good or a bad loan? Very straight. Is it good or bad? A choice between two. Let's hear what 3 people have to say, Jimmy.
Okay, so I'll take from Jesse, Francis, and Dennis says a good loan. There was one from Tony says it's a bad loan, but the majority here we are saying it's a good loan. Wanjiku, Margaret, there's another one saying it's a bad loan, that's Charles. Okay, Stephen says it's a bad loan, but the majority again, Joseph and Amos are saying it's a good loan. Okay. Okay. So over to you, Esther.
Thank you, Jimmy. So we see a number of saying, most are saying it's a good loan, others it's a bad loan. And you're going to look at this, as this case is there. One of the things is that we still see she makes a profit per month, even after paying. So now let's go to another case. Catherine applies for a 5-year loan of 1.5 million from her bank for business expansion. She, however, uses the money to fund construction of her family residential house. You remember our Catherine. And she later draws the 200,000 for bank overdraft for business expansion. And 1 month later, Catherine's business needs working capital, but she cannot borrow from the bank because the overdraft limit is overutilized. So she opts for a Shylock loan of 100,000 at 40%. So the key question here, is this a good loan or a bad loan? I know we have had this scenario before.
Okay, so let me take 4. Very bad loan, Ruth, Joanne, Margaret. Okay, we are saying it's a bad loan. So over to you, Esther.
Well, thank you. Now, since we look at all this, and we have seen there are good loans and bad loans. So what is the difference between the two? What is the difference between a good loan and a bad loan? Let's share. Just probably about 2-3 people on chat. Let's hear your thoughts. What is the difference between a good loan and a bad loan?
Okay, so let's wait to hear here. Okay, Joanne says, I just take 2 because of time. A good loan shows financial discipline, unlike a bad loan. And then Mary says, good loan should be worthwhile the return. So, and the other comments are still coming. So over to you, Esther.
Okay, and we are going to summarize on all this. Thank you so much for those responses. 1, a good loan, it's for developmental purposes. Is it developing you? It's going to generate income. That means it's adding to your pocket. It is able to repay itself. You don't have to borrow somewhere else to pay or go for your savings to pay it. Then it adds to your asset. It's either increasing stock, buying another asset, there is an increment in your balance sheet. It's also at a very reasonable cost of borrowing. The way to judge a bad loan, this is a loan that is for consumption purposes, for a holiday, for consuming anything that will not put money back in your pocket. It is going to be draining your income. You go even for your savings to pay it. It is stressing you to pay. The moment you get to the point where you're getting stressed, then you are dealing with a bad loan. There is a possibility you can lose your assets because even probably paying is a problem. Then you're paying the loan at a very high cost. That is a bad loan for you. It is very clear as daylight. And I know for you now where you are seated, you know whether the last loan you borrowed is a good loan or a bad loan. And for us to be able to complete this, let us look at loan management. Let us look at loan management. And in loan management, we are going to equip you with skills. One, we are going to be identifying the loan management challenges that we have. And also we look at the process of loan management, and eventually we look at the pitfalls of loan management. So the first question I would ask you, and this we are going to go for a poll. What specific challenges do you have when managing your loan? Jimmy, please give us that poll. What specific challenges do you have when managing your loans? Please participate in the poll.
All right, so there we have it. Okay, so let's give it time. And as it does that, let me quickly read some submission that came in. A good loan is a loan which is used for the purpose it was borrowed for. And a bad loan is a loan used for other things. Thank you, Mbatia, for that. And then bad loan cannot be repaid from the business. Thank you, Paul. Okay, so let me bring the poll to a close because I see majority of us has put in the poll there, giving it 15 seconds. Okay. Okay. There you go. So let me quickly share. What specific challenge do you have when managing your business loan? And as you can see there, 76% of us are saying mixing business and personal money. Late payments, 32% of us. 37% of us are saying no cash flow planning, too much debt, and access to loan stands at 24%. So over to you, Esther.
Okay, thank you. I see this is great. We have been talking about Catherine, but I have seen we have several Catherines over here, mixing our loan money, our business money with our personal money. So this course, it's actually designed to help you overcome these particular challenges. And with that, since we have seen the challenges that we face, we are going to identify the process of managing the loan. So, and I'm going to just go through this. The first thing that you need to do, and we have covered it, so it is like a summary, identify the need for the loan. And this is the need according to the business. Then weigh your funding options. You're looking at the amount. You're looking at the type of loan. That is where you're weighing your funding options. Then after that, evaluate your borrowing consideration for you as the borrower. And also remember what the lender is actually considering. Then select the right loan so that you're not tied up with a bad product type. Not a bad product type, but it does not match your need. Then after all this, use your cash flow forecast to plan and prioritize your payments. Remember when we were talking about cash flow management, use that cash flow forecast. After I take this loan, how is the money going to come in? Then to ensure that you don't fall back on your payments, track your loan repayments in terms of which day do I pay the loan, so that always you know either on 10th of every month, that is when I pay my loan. And this is going to ensure that you avoid any kind of loss, either to your business asset, because you have not been able to manage your loan very well. You follow this, I believe that within no time, you should be sharing with Peter and the rest of the co-op team, telling them how good it has been for you. So with all this, now we go to the area where we conclude on the common pitfalls of loan management. What are the common pitfalls of loan management? Please share in the chat, which are those common pitfalls that come about when it comes to you managing the loan? What are those things that really, that you're likely to get into when the loan management goes wrong?
All right, so let's hear. Okay, there was two last comments that came from a previous question, and Alice had indicated bad loans give one sleepless nights. Okay, so let's proceed now. A pitfall of loan management. Liz says stress. You lose your assets. Tony says liquidity. And then let me take two last, and then we proceed. Closing business, bad credit score, and bad character. So over to you, Esther.
Wow, you can see all that. That is what is likely to happen. And among the pitfalls that you're going to find yourself into, to just summarize, you find yourself diverting that loan. You become a total Catherine. Then also, you're going to be taking loans for new business, and you find that you're always taking a business, you open very many business, you become a jack of all trades. Then the poor record keeping, you get yourself over borrowing, you're even borrowing from other people. Then there is a lot of cash flow management. You meet yourself, you don't have cash most of the time. Then most of the time, you usually take the loan and you don't read the small print, the very small one. Please take time to read. Then failure to negotiate for better terms. You're just given, these are your terms, amen. Because you're in a hurry, you just take. Then failure to consider your funding options before taking the loan. These are the common traps that are likely to be there. Please avoid them by following that process of loan management, and you find yourself managing your loan better. Now with that, we come to the conclusion of our course. And to conclude, I want us to go back and look at the objectives that we said. By now, you should be able to explain the borrowing considerations for you as the borrower and from the lender. You should be able to select the correct loan type. You should be able to differentiate between good loans and bad loans. And also you should be able to manage your loans better. And with all this, we are going to be able to share with you these notes so that you can keep referring to them. So, and from all that we have discussed, you should be able to determine the reason for taking a loan. Then you should be able to weigh your funding options and borrowing consideration and select the right loan. I cannot overemphasize. Then take only good loans, leave out the bad loans. And you know when you're taking a bad one, even there is something in your heart that tells you, then manage your loans better. So what I would say is, this course is to really help you to manage your loans better and to overcome all the challenges that we have highlighted. And with that, let us devise a plan to help us manage our loan better. From what we have learned today, which are the 2 new ideas that you're going to implement once you get out of here? Just 2. Share with us. And as you share with us the 2 ideas of what you're going to do after this, I would like to tell you that we have other courses that are coming on board 2 courses that we'll be covering in the next 2 Thursdays. And these 2 will be covering savings and investments, both of them. After we have done the loan management, cash flow management, working capital, let's go to the area where we save and invest. And that's what we shall be discussing the next 2 Thursdays. But right now, what are your action plans? What are your 2 takeaways that you go with?
Okay, so very quickly, Esther, let me take 2 comments there. I see so many are coming. Liz says, I purpose to be taking only good loans. It's what she's taking away from this. Martin says, better financial record keeping. And Liz Munene says, how to manage my business. I guess that's what you meant there. Okay, reading the fine printer, how to manage my loans better, be very clear, okay, no diverting of loans, and so much feedback is coming. So over to you, Esther. I see the CoBank team is ready on the other end. Thank you.
Yeah, thank you. I actually want to hand it over to Peter and Anthony to take us through what CoBank has for us. Eventually, as we clear off, we are going to get the evaluation after CoBank has finished offering. So over to you, Peter. Please share your screen.
Thank you so much, Esther, for that great training, and I think great tips, and you could see the engagements from the customers on some of the things that they are now able to implement in their business. And I think what you're saying is we got an opportunity to improve on maybe how we plan on our loans, and we are now able to know which loan do I take and what would be the purpose, and why should I even pay timely for these loan facilities. So thank you so much for those insights, and I think we continue to engage. And just to say, these are some of the solutions that we have for you in terms of loans for businesses, and we are encouraging us to visit us at the branches, so that then we're able to talk about some of the needs that we have, and we'll see how we support. Without much, I want to invite Anthony Kinyo, who is our head of SME Banking Cooperative Bank, will come over and give us some of the solutions briefly. Then that speaks to what Esther have talked about. So Anthony, proceed with your presentation. Thank you.
Thank you so much, Peter. Thank you so much, Esther and Jimmy. Jimmy, you can confirm that you can see my slide?
Yes, Anthony, and a Happy New Year. I can see it. Maybe you put it on slideshow. There you are.
Now you can.
Thank you very much.
Thank you. And I know it's not too late to tell our customers who have joined us Happy New Year, and also thank us all for attending this session. I'll take briefly 10 minutes just to wrap it up. And also, I think to say we'll continue offering these webinars. This is almost our 60th, our second this year. And I also want to confirm that managing business loan as a topic was one of the topics that were requested by majority of the of us who attended last year. So thank you so much, and again for sparing some time. So I'll go through some of the things. I know Esther has covered a lot, and thank you so much, Esther, for that insightful session. I won't repeat where Esther had elaborated, but I want to say, as a bank, we are very committed to ensure that we support the MSMEs, and we'll continue partnering with IFC to ensure that at least we scale our businesses to greater heights. And for that, we give you a mix of the financial needs and also the non-financial needs and trainings that you help us in our day-to-day running of the businesses. And I also encourage us to continue also sharing feedback with us, so that we are also able to consider even other topical issues that might be affecting our businesses. So just going straight to the point is to say, we'll continue supporting us in our business in terms of the facilities that we give, I know Esther had mentioned a lot on this, but in the banking perspective, we categorize our solutions into three. One will be the short-term working capital needs. I know Esther has talked about when you need to take what consideration you need to have in mind when you're taking a term loan, an overdraft, the trade solutions. I want to emphasize that one of the things that we are very keen on, and especially on the short-term working capital needs and the interactions that I know majority of us in the chat box have really engaged us with a lot of questions. What I want to say is for working capital will cater for the short-term needs, anything below 12 months. What we have done as a bank is we have empowered our relationship managers and our branch managers across the network, so that when you have a need, a working capital need, you're able to walk into a branch manager, talk to your relationship manager, and if you're pledging a motor vehicle as a security, then they're able to give you approved at a branch level 1 million. Again, if you are pledging a collateral as a title deed, we have empowered the branch managers to give you an approval of up to 2 million. So take advantage, but this will again be based on the relationship that you maintain with the bank. And the relationship comes with us allowing us to understand how you operate your business by ensuring that you operate an account, you have a collection solution, you are terminating all the business proceeds to us. And again, also keeping close contact with the relationship manager at the branch and doing consistent banking. That takes care of the short-term working capital needs. We also have other needs that are investment related or expansion related. And I know we talk of asset finance, whether it's lorries, the pickup, the trucks, your personal car, machinery, medical equipment, factory machines, all those asset finance are available within the branch network. There are those of us again who would want to do some construction, some purchase of property, equity releases, those mortgage finance again also available across our branch network. And again, even those specialized medical equipment financing, we have also partnered with the IFC again to see how then do we also facilitate and ensure that we promote the access of health care across the region. So even those specialized medical equipment financing, the solutions are available within our network. Again, if you are not able to access those facilities from a branch network, we have also developed as a digital solution where, as long as you have an account with us, whether as a sole proprietorship, as a partnership, as a limited liability company, as long as you operate an account with us, what I call an MSME account with us, then and having consistent banking, and you're also having our star 667, what we call a name cop cash platform with us, then we are able internally to give you a score or what we call a limit, so that in case of any emergency, then you just need to go to your phone, dial star 667, and you're able to give you a quick working capital need. It's also good to mention we are the only bank in the country that is also able to give you up to 1 million for a tenure of 6 months. And this is just to ensure that then we help you scale up your business, and especially then where you have an urgent need or an urgent deal that you have considered, and you know you'll have return on investment once you take up a loan, we're able to support you that on phone, and those loans are instant. Again, a good thing is to say it doesn't matter whether you have other working capital short-term needs or short-term loans or investment loans like asset finance and trade and mortgage. This facility, digital facility, we're able to give you on phone, and it can run concurrent with the other facilities. And finally, for me, I think we're also saying being a bank that want to support MSME, we're looking for our partners. But IFC have been a good partner. We're also partnering with the government to see what else can we do, and especially from the interactions, I got a lot of question on in micro or in small enterprise business, how do we access loans? And one of the things that we agreed with the government is let's support even those who are coming up very well, those who are starting their businesses. How do we support you? And for me is to say we have a working capital credit guarantee scheme that we have signed with the government with the name of promoting small enterprises and ensure that we take you through, especially for your business needs. We're saying this is strictly for MSMEs, those who have a registered business, you have a license, whether from the county, you are a taxpayer, then walk into any of our branches. The good thing with this loan is we have eased or made it a bit easy to access, not like the other normal loans, because we are saying if you want to rebuild your business, if you're looking for working capital, if you want to acquire that asset that is ranging between 1,000, not the minimum limit, 1,000 up to 5 million, then if your business need fits within that limit, then we're able to advance you that facility up to 36 months. And we have done a preferential rate of 12.5% as opposed to, I know some banks are up to 16%, majority at 13%, but this one we have negotiated. And we have also made it so easy across the network so that we have a fast turnaround time. Any application you make across the branch before noon, then we're able to give a decision the same day. And you're saying then again, this being a very critical loan for us for rebuilding and ensuring our MSME customers thrive, then we say we are not limiting it. It doesn't matter whether you have another asset finance, another working capital, another loan. The loans can run concurrently as long as the purpose is justified, as Esther has taught us, and we are within the 5C of lending. You have the capacity to borrow, you understand the condition better, your character is okay, then you're able to qualify for this loan concurrently. We're also saying we have a flexible approval terms, both secured and unsecured, at a branch level and at a head office level. The branch manager has been empowered to do up to 2 million at the branch level. Consistent banking for us will be very key. Ensure that you patronize our accounts, a collection platform that you're able to see, to our collection solutions that are available within our branches. I liked a comment from Esther where she said that the bank is able to know the character of the borrower by just looking at the statement. How do we know that you're fully banking with us? How do you operate your account? How do you repay your loans? That defines more on your character. And what our request is for us is please operate an account with us. Operate an account with us. Patronize our collection solution. Keep on engaging your branch manager, your business banker at the branch, or relationship manager is your advocate. Keep on talking to them and engaging even after these forums. Bank all your business incomes. They are able to, at a branch level, we're able to show you or give you some gadgets that are able to ensure that we understand you better by giving you our collection platforms. Again, this was, and I know Esther has covered this very well, identify and present your business financing need. Now we have been empowered. Leverage on this training to identify your needs and get the right solution for your business. And again, on this, to ensure loan repayment for ease of future loan qualification. One of the things that prompted us to do this training on managing business loan is last year we had a tough period, all of us in our businesses. The bank came in to give restructure, to give moratorium. We're also saying that once you understand your business, the bank will play its part. On your side, also have those discussions to ensure that then you don't miss on any timely or on any repayment, so that you're able to engage where you need to reschedule, where you need to, get a moratorium, engage so that you keep your record and your borrowing history clean, so that even when we are pre-qualifying you for some certain limits becomes easy for us, and also for you to qualify for huge loans in future. Then lastly, for me, very instrumental, keep attending all the webinars. We are doing this together with IFC, and what we are basing on is the needs, the business needs. What are the topical things that are affecting our businesses, so that then we're able to customize a training that will be beneficial to your business, so that as you scale up, as you expand, then you don't ignore some health issues, health checks of the business here and there. So these trainings, we'll do them every Tuesday, Thursday, sorry. And I know Esther has mentioned on the upcoming two Thursdays what is in stock. So thank you so much. I think from the bank that is it from us. Maybe Jimmy, for the interest of time, I can pick 2 or 3 questions. I know I have myself and Peter, we have been answering those questions. Maybe you can check out some few questions for me before we wrap it up. Jimmy?
Yeah, thank you very much, Anthony, there. And there's very good feedback concerning the products there, and people are really excited to know and being able to access this. There was a quick comment maybe from Geoffrey Omondi, says, process of getting loans is quite complicated. Please make it simpler. Maybe you want to respond to that, and then we can bring this one to a close, because most of the questions have been answered on the Q&A, and I don't see any burning question on the chat box or on the Q&A.
Well, thank you for the feedback. One of the things that I mentioned is yes, the process of acquiring loan traditional has been viewed as very rigid. And as I mentioned is that what we have done as a bank is we have tried to decentralize the approval authority, so that we don't have to see each and every application with Peter from head office, that the branch manager has a limit of 2 million. Number 2, we have also said all our MSMEs, if you're operating an account with us, we have at the back end given you a limit that you're able to access a facility. We have given you a limit, and the trick to the limit is just 2 things: consistent banking and timely repayment. Number 3, we also want to comment maybe, and I know possibly the customer is coming from that angle. Sometimes on landed, or where we're taking collateral as land, and we are doing the charging, I know we have had some outside challenges. There are challenges that are to do with the registry, possibly where we are not able as a bank to also have that process in our control. And especially on the landed property, I know there is a challenge. Last year, we had some of the registries doing the upgrade, others being told to halt any transfers. But again, I think as a bank, we are saying, let's patronize our both digital and leverage on our branches and relationship managers limit that we have accorded them. Thank you, Jimmy.
All right, thank you very much, Anthony. So the other quick comments, maybe I would prefer you comment on them. There is Charles says there's need to review bank transaction charges. The market is very competitive. Other institutions allow transfer from and to M-Pesa free of charge. And then there's another one from Batia, says there's need to work on your cooperative bank app. It has challenges on its functionality. All right. So maybe you can comment on these 2, and then I can bring this one to a close. Otherwise, I've put up the evaluation poll. So as we take your comments, as we take your questions, please be sure to put your poll there. Let us know of how this training has been. Otherwise, over to you, Anthony.
Thank you so much for the feedback. One of the things that is so exciting for me when we have webinars is and I say is feedback is the breakfast for the champions. There's a key takeout for me, especially on the review of charges, the free that I will take it up so that we also become competitive. And thank you so much. Even in this webinar, please, on the areas that we have done well, comment on the areas that I need to improve so that I become better. And as you benchmark my services with the other banks, I'll also take all the feedback and work on them. The review of the charges, that I'll take it up. And thank you so much. On the other one, on the M-Pesa app, we are currently doing and testing. We're in the final phase of testing a new platform in the bank called Omnichannel. And I know I'll be talking later on. We'll arrange and take us through. So we are doing an upgrade, and in 1 month or two, we'll be launching it, and we'll come to you, go to the media, you see it, just to improve our services, especially on the mobile app, because that is the quickest interaction platform that we have with our customers. So thank you for that feedback, and continue sharing with us the feedback. Otherwise, Jimmy, as I hand over to Peter, is to say thank you so much for listening to us. May God bless you all. Over to you, Peter.
Thank you, Jimmy. Hope you are done from your end. Okay, thank you so much for that session. I want to take this opportunity to really appreciate all of you, our customers who have been very, very patient to be in this particular session, and you really participated through the question and answer session, and also through the chat box. We have really learned together, and we've really been engaging. We have also taken the feedback that you have given us. So we really appreciate all of you for that patience and that engagement. And we are hoping to have this one in another session come next week. I also want to take this opportunity to really appreciate the team that have presented, starting with Esther. That was very, very informative, Esther, and we really appreciate your training and the insights. And I think our commitment to you, maybe taking it on behalf of customers, is to say we are going to implement these insights, because they are supposed to help us on how we manage our businesses. Thank you so much, Anthony, again, for coming through to share the insights and some of the solutions that we have as a bank, and we committed to continue giving these solutions and support to our customers. Thank you so much, Jimmy, for the great support. Winnie and Gideon, thank you very much for being in this particular session and working in this particular program. At this point, I really want to stop, hoping that we are going to have the next session on Thursday, same time, and this time loud, we'll be talking about savings and investments. Once we know through with loan management, then we're able to save and invest. Asanteni sana, I wish you well. May God bless you, and God bless the work of your hands. Bye-bye.
Thank you very much.